So welcome everybody. Thanks for joining us, and let's get to it right away because I don't think I do have a long. I don't have a long presentation actually. There should be plenty of time for Q&A. If there's anything that I have not addressed during my presentation, I'd be happy to take any questions. Um, as I said, very at the introduction or at the very beginning part of my presentation, we're going to be focusing on our trade report, Trade 2018 Trade Ranking Report. Every year around this time of the year, we actually release what we call our trade ranking report. So we look at Canadian performance, sometimes on the import side, mostly on the export side. This year's report is mostly about the export side, although I'd be happy to address all the import competing sectors as well. Mostly addressing export. And every year we try to identify one theme that we think is very relevant to the current year. And this year it was really hard to get away from volatility. And so in the previous years, we've looked at the impact of the Canadian dollar. We've looked at trade agreements. We've looked at productivity. But this year we thought 2018 has really been defined by volatility. So what can we say about Canadian performance historically when it comes to volatility in the marketplace? And hopefully looking at past performance and the historical relationship between exports and volatility, that can teach us a little bit of something around what we can expect for 2018 and 2019. So there are two parts to this. One, I'm just going to focus on the most recent set of data that we have, which is actually for 2017. Look at where we stand in the world when we are thinking of exports. We're going to dive in a little deeper into some of the sources of volatility, focusing on a few sectors and really zeroing in on volatility. When you look at our export performance, this is something that I think everybody is aware of. We're the fifth largest exporting nation in the world when it comes to agricultural commodities. So right off the farm level, what we sell at the farm level, and when it gets to export markets, we're the fifth largest exporter. We've been in this position since 2011. When we went from 6 to 5. And so at roughly 26 billion US dollars, we're the fifth largest exporter. The country ahead of us is Brazil. The Netherlands is number 3, which is interesting because the Netherlands are actually half the size of Canada when it comes to population. So there's a few lessons to learn for sure when it comes to the Netherlands. And if you focus on the value add, as an exporting nation, we're ranked now 11th. We've been 2007, I believe it was, when we went from 13 to 12. And 2014 was when we went from 12 to a current position at number 11th. The one thing you'll notice as well is that the spread out or the mix of market share of those different exporters is a bit different on the food side than it is on the commodity side. On the commodity side, you have the US, and you have the following 4 countries. In this case, we got Germany, the Netherlands, and 1 and 2 in the US, not too far behind. And after the top 3, you got Brazil, and the 7 next exporters are not similar because there's some significant differences. For example, if you look at what we export out of Canada versus France, but because at 20 billion versus 30 billion, but there is a little bit more, little less diversity when it comes to size of those exporters when I look at food versus ag commodities. So there's something for us to be thinking about, the ability for us to actually increase exports. As I'm sure a lot of you know, we have some pretty ambitious goals as well to export more. The official target from the government of Canada is $75 billion worth of exports by 2025. So if you add up this $20.4 billion worth of food to the 26 billion on the previous slide, so that gives you 46 billion. That's in US dollars. Converting that at a rate of 1.3, that gets you around a little over $60 billion worth in Canadian dollars, 60 billion worth of exports. So to get to 75, you need to grow current exports by about 25%. We got 8 years remaining to achieve that target. So this is data from 2017. So 8 more years, growing at roughly a rate of 2.5% to 3% would take us from 60 billion or 60 billion Canadian dollars to 75 billion Canadian dollars. So it's totally on target and totally achievable if you look at past rate of growth. But certainly as well, we have to roll up our sleeves and thinking about what kind of policy, what kind of business strategies do we need to be able to achieve those that ambitious target. And so in the spirit of the current presentation, I do think that volatility is actually quite relevant to think about our ability to reach that target. But before I get there, one of the reasons that beyond all the noise, I think if there's one thing that makes me and makes a lot of people optimistic about the future of our industry is the idea that demand remains extremely strong. So if you put aside the noise, that noise is important. I'm not diminishing the importance of all the noise when it comes to policy, trade disputes, volatility related to weather, related to lots of different things. But if you put that aside and if you focus on the fundamentals in the marketplace, demand for food and agricultural commodities remain absolutely strong. So this is one of the things that, like I said, if you're just willing to look a little bit beyond the noise, the demand for food in the world remains really strong. There's some really cool way of illustrating this. I mean, the Economist put this together, right? In the next 40 years, the world is going to need to produce as much food as in the previous 10,000 years. So that's actually makes you think about the scale of the objective here in terms of achieving this. The FAO actually has a very well publicized tagline as well when it comes to food production, right? It's the idea that we're going to need to increase food production by 60% by 2050. The previous number was 70%, but it's been revised downward not too long ago based off some changes in assumptions and changes in the baseline years that you use to compute this. But bottom line is, with population increasing, income still increasing, there are no signs that demand for food is slowing down. So I think that's the good news. And so that put that in context, then the idea is how are we going to navigate the current environment to be able to supply some of the food that's needed in the world. So to introduce the topic, I'm going to rely on an acronym that comes from the US military, actually. It's VUCA, and some of you may have heard this. I really do think that despite the fact that it is something that is brought up by the military, I think it does apply to the business environment for food and agriculture right now. So VUCA stands for volatility, uncertainty, complexity, and ambiguity. And as I said, it's based off from the US military that was looking at modern warfare and how modern warfare is actually nothing like it used to be in the past. Actually quite relevant that we're talking about this, given that we're just a couple of days after Remembrance Day. I'm no expert in military, so I'm going to leave it at that. But it's the idea that nothing that right now military is doing looks like what the military used to do in the past. And I do think that it does apply right now to the environment that we're in. If you think at the sources of volatility, I think we're quite familiar with production risk, marketing risk when it comes from changes, unexpected changes in supply, for example, due to a poor crop or a bigger crop than expected, and so on. But when we have some of the uncertainty and volatility in the marketplace driven by some policy decisions, as we're seeing right now, and I'll say more about that in just a second, I do think that we're in a volatile world. Uncertainty and complexity are not going away. And it's quite ambiguous right now, right? If you think of what's going on in the marketplace right now, and you think of 2019, well, what kind of assumptions do you make when it comes to commodity prices for 2019? Right? How do you base those assumptions? How do you form those expectations about the marketplace? So that's a little bit of what we want to get at. And we want to make sure to address these in a context of export performance. Now, obviously, one of the biggest sources of uncertainty and volatility in the marketplace has been those trade tensions between the US and China. We got three rounds of U.S. tariffs applied to exports coming out of China. The first two rounds was on $50 billion worth of exports from China that the U.S. was taxing. Now there's a third round on $200 billion worth of exports out of China that was effective in September. I believe September 24th was the date. So that tax is now 10%, and it is scheduled to increase to 25% in early 2019 if there is no agreement between China and the U.S. China has retaliated against some exports out of the U.S., most notably soybeans and pork. I'll get to that in a second. And it seems to me, anyway, that if you think of it from the U.S. standpoint, it seems to me that their perspective is that China's going to run out of export to tax before we do. And I think it's a bit short-sighted and misguided if you think along these lines, because China has plenty of other tools to actually retaliate against the U.S. They could audit U.S. businesses a lot more than what they're doing now. There are plenty of ways for China to actually increase the cost of doing business in China for U.S. Exporters. So I don't think those trade tensions are not going to, they're not going to be over anytime soon. There are some discussions involved right now between officials in the two countries, but right now I just don't know that anything will be resolved anytime soon. So we're likely to see more of those trade tensions for the rest of 2018 and into 2019, and that's when it starts to get interesting. When we get to that 2019, thinking about what the impact could be in the world markets, especially for us in Canada in terms of our own production and our own exports, that's when it starts to get interesting. I'm pretty sure that a lot of you are familiar with that particular chart. This is the price of soybeans in the US dollars off the Chicago market. And as you see, starting in, I was going to say late spring, perhaps middle of spring, this is when we started to see a lot of impact out of those trade tensions on the market for soybeans. Big decline in early June or late May, early June. A little bit of a rebound in the marketplace. Further decline when we had news that the size of the soybean crop in the U.S. was going to be bigger. Actually, distinguishing between what is volatility triggered by trade action, like this in this case, China taxing U.S. exports of soybeans, versus what is price movement driven by the size of the crop coming out of the U.S., that's really hard to do, right? And there's no easy way to distinguish the sources of volatility. But we know one thing is that those trade tensions are creating a bit of volatility. As I was saying, what really happens in the marketplace is that what we're seeing in terms of increased production, so if you focus on the bottom chart for the U.S. and the blue bar there, you see 2018-19, or the 2018 crop of soybeans in the U.S. being really big compared to 2017, 16, and 15. This steady increase in acreage as well as really good yields is actually lifting production of soybeans, and that stock-to-use ratio is climbing, not only because production is going up, but also because exports out of the U.S. are going to be down as well, with China taxing U.S. exports. And if I can just go back to that previous slide, I mean, this is not surprising to see something like this. As you'll see later on, China imports about 70% of soybeans in the world. So if I'm China and I'm taxing U.S. exports of soybeans, what I'm doing is I'm raising the price for Chinese buyers of soybeans. And so if those buyers are actually facing a higher price for purchasing soybeans out of the U.S., they're going to be lowering their demand. And that lower demand, given China is such a huge exporter or importer of soybeans, that lower demand is going to trigger a decline in the price. That decline doesn't have to be the size of the tariff, in this case 25%, but it looks to me that roughly, that decline in soybean prices has been, roughly equal to 25%, which, as I said, it compounds the impact of the policy with the impact of the size of the crop. So another source of uncertainty for us has certainly been the Nafta renegotiation. So in some ways, if the USMCA, and I'm saying this is an if because at this stage we're not 100% sure that this agreement is going to be ratified by the U.S. Congress with the election that just occurred in the U.S. and with the Democrats actually now controlling the House of Representatives. It's not a slam dunk that this agreement is going to be ratified by Congress. Having said that, I do believe that it will. I think the Democrats have been vocal about trying to have the U.S. government introduce some provisions or some kind of support for workers in the U.S. as a result of this new agreement. They don't have to do it within the agreement. It can be done outside of the agreement, meaning that the Democrats could say, well, if you give us this piece of legislation, then that relates to workers in the U.S., then we're going to vote yes to the USMCA, which is NAFTA 2.0. So it remains to be seen. I am actually confident that this is, or I believe that this deal is going to be ratified in the U.S. as well as in Canada. So that would lift the cloud of uncertainty that existed for the last 12 to 18 months, even when it comes to those trade negotiations involving the U.S., Mexico, and Canada. So for exporters, that brings a bit of relief. As I said, there's this cloud that is going to be removed. Whereas for import competing sectors, if you think supply managed sectors, for example, it creates a bit of more pressure. The extent of those pressures different according to which sectors you're in, dairy versus poultry, for example. But it creates more pressures for those import competing sectors. But from an export standpoint, it does lift the cloud of uncertainty that existed because of those NAFTA negotiations. One point to make, before I get into the details of export performance versus volatility, one point to make is that the diversity of Canadian exports makes us resilient. So if you would look at all the other countries that I pointed out in the top 5 of those top exporting countries for commodities versus the top food exporters, if you would look at the breakdown of these countries, perhaps aside from the US and some European countries, they would not have a pie chart as evenly split as the one that you're seeing for Canada. The fact that we're very diversified when it comes to exports makes us resilient from an export standpoint. So a little bit easier, not easy, but certainly easier, I would say, to keep our performance the way that we've seen, our number 5 rank when it comes to export of commodities. So that's really something that makes us more resilient when we are faced with more volatility. So we need to be thinking about, this is both commodities and food. So there are some commodities there that are actually processed and not the straight raw primary commodities. But this is the breakdown of both ag and food as well all together. So that's something to remind ourselves as well. So from the export market side of things, though, the fact that we're going to have access to more open market access in Europe, as well as that we do have more open market access in Europe, as well as pretty soon have more market access or more open market access in some Asian countries that are part of the Comprehensive Trans-Pacific Partnership, so CPTPP, is also that helps out quite a bit in terms of making us resilient when it comes to the volatility that we face and the uncertainty that we have in the world marketplace. I'll say more when I dive into some of the specifics of sectors, but those trade agreements, the fact that we're going to soon implement CPTPP, as well as the fact that we do have now a trade deal with Europe, actually helps quite a bit, making us more resilient from an export sector. So the question is, does volatility impact exports? Right? And so you have, word of caution here. So a lot of assumptions in some of the data that you'll see later, in just a moment. First, we have to define how we're going to measure volatility. And so we have to take, volatility is prices moving up and down, right? So we do have to have a time period over which we're going to measure volatility. You can pick 6 months, 12 months, 24 months. We're going to work with 12 months. So in order for us to say that we have a more volatile environment, we need to sustain prices swinging up and down on a more frequent basis over a period of 12 months. It doesn't mean that prices need to move up and down real fast for 12 months, but over a period of 12 months, we're going to measure the frequency at which prices move up and down. So that's the one thing. We're going to focus on 12 months. So short term, it's going to be really hard for us to say anything about exports because we need to define volatility. And so we looked at the number of different measures and we basically settled for 12 months because this is when we thought the data was speaking a little bit more than compared to other cases where volatility is measured over a short period of time. Because over a short period of time, businesses don't necessarily tend to change their production plans, their export decisions. Then we're also going to look at historically what has been the relationship between volatility and exports. So what you'll see in a minute is not necessarily a forecast of what we expect 2018 exports and 2019 exports to do in the face of or faced with more volatility, but more what has been the relationship between volatility and export performance. And to really focus and narrow down or focus on volatility, we need to account for everything else that does have an impact on exports. So for example, the price level itself has an impact, right? The higher the price, the more I'm going to export to that destination and the more production I'm going to have and then the more exports I'm going to do. And vice versa. The lower the price, the fewer exports I'm going to have. We need to account for the strength of demand in these export markets, right? So the higher income is in an import market, the more you're going to export to that market as well and vice versa. So we need to control for everything else that does have an impact on exports. And then when you bring in volatility and you look at how historically what has been the relationship between volatility and exports, and that leads you to understand now what could happen if we do have indeed more volatility or continued volatility in 2018 and early 2019. As I said, right now, we don't even have, I would say, if you focus on those trade tensions, for example, we don't even have 12 months of data when it comes to measuring volatility. And there is no way to actually, because the sources of volatility are so different, there is no way to actually predict volatility, right? So it's not about making predictions for 2018-19. It's more about looking at historically in the soybean market, in the canola market, in beef, pork, what has been the relationship between periods of when prices move up and down frequently or more frequently than another period? How did exports behave at that time? So it's really looking backward, try to understand what could be the impact in 2018 and 2019. When you think of it, as I said, if volatility started out in the spring of 2018, or maybe at the earliest in the early part of 2018, still don't have 12 months of data. So we're going to need a little bit more time to understand what is the long-term impact of volatility. Short-term, we know that it can lead to some sales that are being moved away from some markets to some of the markets because the demand coming out of China for soybeans is a little bit stronger. For Canadian soybeans, is a little bit stronger, given that U.S. soybeans are more expensive. That sort of effect we can measure. But to look at, are businesses less likely to increase production when prices are volatile? We need to look at what historically has been the behavior of those exports when faced with more volatility. Importers can postpone purchases, exporters can delay sales, and it makes a whole lot of sense also to focus on the long term. So if you think of crops, perhaps it's not until, because we got the crops that we have right now, right? So it's been seeded, now it's harvested, and we got some challenges getting the crops off the ground. But now it's in the bins and in the elevators, and we do have production to sell, and we're going to make those sales. We can rearrange some sales towards destination A, B, or C versus X, Y, and Z. But other than that, we're going to be selling what we have. It's when it comes to the next crop year that we're probably, may see producers actually make different decisions. And similar thing with livestock markets, right? It requires a bit of time for producers to adjust. And there's always a lag, as we know in agriculture, that makes agriculture unique. There's always a lag in between when production decisions are made and when marketing decisions are made. So that, just to keep that in mind, this is a little bit of the reason why we need to actually have a little bit more of a time horizon to measure volatility, instead of just focusing on the short term. Okay, having put all these disclaimers out there, let me focus on a few sectors first. So if you look at the soy market, so we do have on the left-hand side the breakdown of the destinations of Canadian soybeans exports, and on the right-hand side, that's the breakdown of the market share of the largest importers of soybeans. So on the right-hand side, you see China at 70% market share. The soybean market is about China, and it's really, frankly, the end of the story almost. When you look at our own exports, China accounts for roughly, or this is 2017 data, by the way, China accounts for roughly 40% of our export. Japan comes in second, and then we got a few European destinations that are actually interesting to look at. I'll say a few words about that. But really, the idea is that China controls a lot of the imports, and for countries like the US, which have a bigger market share than we do, now it makes it interesting, or the volume itself, it's not just about market share, but it's also about the volume. It makes it interesting for a smaller exporter like ourselves to think about what can happen if we do have more volatility when it comes to the export price. So what we're doing, as I said, is looking backward at the relationship between the volatility of soybean prices and our export performance in various markets. And as you see, there are some cases of soybeans where we do have our exports that have actually gone up when volatility has been going up. Now, to put a number on the export response, we need to put a number on the volatility increase that we're assuming. And so to make the numbers stand out really big, we're going to assume that volatility doubles. Now, doubling volatility is actually a pretty significant event. It doesn't happen very often. Think VSC 2003. Think the years leading up to 2008, and then the financial crisis of September 2008, and sort of the major steep decline in commodity prices, right? So, to see something like this, you need to actually have quite a bit of volatility. So just I'm putting this caveat out there. So the direction's correct, but the extent or the magnitude of the export response is function of what you're actually witnessing in terms of volatility. If we were to see soybean prices continue to move up and down, just like we started to see in the spring of 2018, and then we see soybean prices move up because perhaps there's some talks between China and the US, and then we see these talks collapse, and then we see prices come back down again, and so on. So that's when you would likely see volatility to that extent for a 12-month period, and then have some sort of response similar to that. In any case, it's possible to see with higher volatility to see our exports respond in a positive way. Spain is actually a really neat, interesting story because there's a pretty big response of Canadian exports when prices volatility goes up. There is a response as well when the volatility goes up. Most of that volatility is function of what is going on in the U.S. market, because as you all know, our soybean prices function in the U.S. market, and there's a bit of decline in other markets as well. If you sum all the export responses all together and looking at Canadian exports of soybeans, not by destinations, but all together, you look at all these export responses, you actually find that the export response is slightly positive. So because of that, it leads me to believe that if we do have more volatility, to the end of 2018 and even in early 2019, we're not likely to see our export performance. We're not likely to see production plans first change significantly. Historically, that's what this is telling us. And we're not likely to see our export performance in terms of volume being exported change significantly. Now, one caveat as well, this is not addressing farm income, right? So don't look at these numbers and saying our export performance is not dropping, it's actually going up, which means that producers are better off. Selling more, which is the case here, at lower prices is not necessarily a better thing, right? And in this case, I would argue it's actually not a good thing. But fact of the matter is, if you just focus on exports or ability to for our products to reach export markets, there are some opportunities that volatility brings when you focus on soybeans, and that's what the bottom line is for this particular chart. If you focus on pork is also another interesting story because not only China retaliated against U.S. tariffs on its own exports and by taxing U.S. export of pork, Mexico also taxed export of U.S. exports of pork in retaliation for the U.S. tariffs on steel and aluminum. So there've been quite a bit of volatility in the hog prices as well. If you go back to late summer 2018, we've seen prices a huge steep decline in hog prices and pork prices, and as well as a bit of a rebound now in the pork market. So if we do see that volatility to continue to evolve into the rest of 2018 and into 2019, what is the expected impact on exports? We're focusing first on the breakdown of our export destinations. You see the U.S. number one, while U.S. and Japan really in terms of value, capturing roughly the same share of our export values. In terms of volume, we ship more to the U.S. than in Japan. It's just that Japan, the value of our exports is higher on a per unit basis than it is to the U.S. And you see after that, China, Mexico, South Korea. If you look at the breakdown of pork imports on the right-hand side, you see that some European nations, Italy, Germany, Poland, and so on, do have a significant market share when it comes to importing pork. And so that does actually represent an opportunity for us as part of CETA if we're able to actually export more as a result of the trade agreement that we have with Europe. But exporting to Europe is not necessarily easy. You know, the German and Italian markets are quite different. You're not talking exporting the same products. If you think of Europe as one single market, I think actually it's a bit misleading. I'd rather think of the way that we're doing it now in labeling these European markets differently so that you can focus on some of those different markets instead of looking at Europe as one big market. It is one big market, but it's also a market with different food consumers, and so you have to also account for that. But again, doing the same exercise, this is where you see that volatility when it comes to pork exports, again, assuming a really big shift in volatility, something that we've seen in the summer of 2018, late summer, early fall, and continuing for 12 months. We were to see something like that, then this is perhaps what you're likely to see in terms of our export response over time, 12 months from now. A little bit of a response. Interesting to note that when it comes to our most important markets, Japan and the US, we're seeing a small response, export response when faced with volatility. It's for the other markets, China in particular, and Mexico and South Korea, which is interesting given that we do have a trade deal with South Korea as well, that we're seeing a little bit of a response. But our market share in Japan and the US sort of shields us from too much impact on the volatility front. But if we're to see volatility last for 12 months, I would expect our exports, pork exports, to decline about in that range of 2 to 4%. Canola is interesting, especially considering what is going on in the soybean market. So this is the breakdown. This is canola seeds, by the way, and this is actually quite important to note because, when I'm going to talk about the right-hand side of this chart, this slide, then there's a few things to say about canola seeds versus canola oil. But if you just focus on canola seeds and you look at China being our largest export destination, Japan number 2, Mexico, and so on, and you compare that with who imports canola, you see Germany stands out, right? And the idea is definitely tied to the biodiesel market, Germany importing from other European nations. CETA will provide an opportunity for us to capture more value when it comes to canola oil instead of exporting the raw product. Perhaps would be easier to export canola oil under CETA because we're not going to have to face a tax at the border. And so that 25% to me is an opportunity for sure, and an opportunity perhaps for canola oil, which is not necessarily something that you see here because we do have free market access when it comes to canola seeds. So it's going to be interesting to actually keep an eye on this, and you're seeing the breakdown of those different export destinations. Canola has benefited slightly to some extent from the trade tensions that have been ongoing between the US and China. But if you just focus on the volatility with respect to canola prices, not bringing in the story for now. If you just focus on canola volatility pricing, this is what you see in terms of export responses historically. So our exports of canola have been weaker when we had a period of high volatility for 12 months and more. We're not seeing this right now, and hopefully we're going to continue to have a less volatile environment for canola than we have for soybeans. And in fact, the volatility that we have for soybeans actually is an opportunity to see some of those export responses actually turn positive when it comes to exports of canola. So something to keep in mind here. I'm just focusing on canola, but the volatility for soybeans can actually be a positive thing when it comes to canola sales in the export markets. And I would argue that some of the trade agreements actually gives us an opportunity to process more and add more value domestically to canola seeds. Now, beef, I'm bringing up beef because it actually brings a little bit of contrast with pork. Remember pork, I said the export response following volatility in the hog prices and pork prices has not been very strong. It's actually not the case for beef. So this is again the breakdown of our market share for Canadian exports of beef. The U.S. captures 3/4 of 75% of 76% to be exact of our Canadian exports. Hong Kong, Japan, Mexico, China, other destinations. So what is interesting to note is when our market share does not necessarily match the one that we're seeing on the right-hand side. For example, if I focus on China, China imports 8% of all the beef in the world and only accounts for 4% of our exports. So perhaps there's an opportunity there to sell more beef into China. Japan is an opportunity as well with an 8% world import market share versus an export market share for Canadian beef of 5%. So a little bit of a something here that we can match better a little bit. That suggests to me that there's a little bit of an opportunity, especially with CPTPP, that would lower the cost of Canadian beef compared to other suppliers, namely the United States. But focusing on volatility here, this is the export response in for one market, Hong Kong, which is really closely tied to China. You're seeing an positive export response. But overall, the export response for Canadian beef is a little bit stronger. And I'm going to be focusing on the U.S. As I said, the U.S. captures 75% of our exports of beef. And you see that the export response for the U.S. is stronger than what it was for pork. So when you can say pork historically didn't really look to be affected by the volatility in the marketplace, especially when it comes to hog and pork prices. When you look at cattle and beef prices, there's been a little bit more of an impact. And yes, that's a function of what we've seen for BSE. And BSE was a special set of circumstances, but it's also not strictly related to just 2003 and the following years. There's actually something that we've seen in the data that says anytime we have more volatile prices, we tend to see production decline a little bit faster. As we know, the cattle inventories in Canada has been declining since 2003. And we've seen the inventory decline a little bit faster, which has led to weaker exports when we have periods of high volatility. So a little bit of a different lesson here when it comes to cattle and beef than what it is for hogs and pork. So I'm going to end with this. I thought I was going to take a little bit less time, but I'm right at the 40-minute mark. So just remember that volatility has limited impact on exports short term. There are some opportunities, some costs associated with this. Opportunities, if you think of the trade tensions between China and the U.S. when it comes to oil seeds, pulses in some cases. We do have our own tensions with India, on the pulse front. But when it comes to peas being a substitute for some imports of oil seeds or oil meal into China, that has created a bit of an opportunity for sure. But it has limited impact on exports short term. It's really when it comes to long term, when we do have those longer periods of volatility, that we do see a bit of an export response. And most of the time, this has been negative. And so this is something that we have to keep in mind, especially when it comes to risk management. So remember those 4 letters, VUCA. I'm a big believer that we're going to live in a VUCA environment for quite a bit of time. that the environment is not going to be less volatile, is not going to be more certain, is not going to be less ambiguous than it is right now. I think we're going to have to live in this environment for a while. And that sort of raises the question of like, what does it change for us in terms of risk management? The sources of risk are shifting. As I said at the beginning, I think we're, I was going to say comfortable, certainly have some knowledge on how to manage production risk given the tools that exist. Certainly as well, we're okay managing marketing risk given the tools that exist, because we knew that we had some comfort knowing where the sources of risk were. But this actually is a little bit different environment that we have. Those supply chains are getting more complex. There's less transparency when it comes to pricing, I would argue. So all of that brings sources of risk, and it does raise the question of how we're going to address these sources of risk. We need to be thinking about risk management. We are in the process of revising business risk management programs in Canada. So I do think that this is going to be a plus. But I think the question needs to be asked. Does it change anything when it comes to risk management? I do believe that we need to raise our game when it comes to risk management. And that's going to be a really big source of competitive advantage moving forward as you're thinking of this VUCA world where we have more volatility, more uncertainty, and more complexity in the supply chain.